All right, let's dive into American Vanguard's second quarter earnings. Now, on the surface, the numbers looked a little mixed. But the market's reaction? Well, that tells a completely different story. A really powerful one about a company that's right in the middle of a huge transformation. Let's break down what's really going on here.
Okay, so here's the core puzzle. American Vanguard's revenue came in just a hair below what Wall Street was expecting. A slight miss. And yet, the very next day, the stock just surged up over 9% on massive volume. So what gives? Why the huge disconnect?
And that, right there, is the million-dollar question. The answer is that smart investors looked right past that tiny revenue miss. They saw something much more important, much more compelling, brewing just under the surface. This wasn't a story about top-line growth, not yet. This was a story about a fundamental shift in the company's health. And here is our very first clue. You see, analysts were bracing for an 11-cent loss per share. They thought it was going to be a rough quarter. Instead, the company delivered a loss of just 3 cents. That's an 8-cent beat, and get this, it's a 93% reduction in their loss from last year. The big takeaway here? Profitability is coming back, and it is way, way ahead of schedule. Now, this is where things get really interesting. We're looking at adjusted EBITDA, which is just a key way to measure a company's core profitability. It surged a massive 79% compared to last year, hitting $11 million. I mean, this wasn't some small beat. This was a giant flashing sign that the company's ability to generate cold, hard cash from its operations is getting dramatically better. So how'd they pull that off so fast? A huge piece of the puzzle is right here on this chart, expanding gross margins. They hit 31% this quarter. That's the highest they've been in over a year. This isn't a blip. It's a clear trend of better manufacturing performance and just plain smarter cost management. This is exactly the kind of thing you want to see in a turnaround. And you know, this new discipline wasn't just on paper and the income statement. It flowed directly to the balance sheet. Management absolutely slashed inventory by $53 million and paid down $22 million in debt compared to last year. This is a crystal clear sign that all those operational improvements are creating a stronger, much less risky financial foundation for the whole company. And make no mistake, this was no accident. On their earnings call, the CEO, Doc K, came right out and confirmed it. He said this is the direct result of a deliberate business transformation. The numbers we're seeing today, they're the first real, tangible results of a super focused strategy to reshape this company from the inside out. So, what is this master plan? Well, it really just boils down to 3 core pillars. First, getting way smarter about how they buy things with a formal procurement discipline. Second, seriously improving something called their SIOP process. And third, keeping a very, very tight leash on their operating expenses. Just a quick little refresher on SIOP because it's super important here. It stands for Sales, Inventory, and Operations Planning. Basically, it's a process that gets everybody, sales, manufacturing, finance, all on the same page, singing from the same hymn sheet. A better SIOP process means less wasted inventory and way more efficient production, which is exactly what we saw in their numbers. And here's the proof in the pudding on their cost control. Look at this. A year ago, operating expenses were 31% of their sales. This quarter, just 27%. It just shows they're running a much leaner, more efficient business, which is absolutely critical for hitting those long-term margin goals they're targeting. Now, what's so great is that all these internal improvements are happening at the perfect time. The world outside is starting to turn in their favor. The worst of the inventory issues in the ag chem space seems to be over. The ag cycle is showing early signs of life. And you've got new farm legislation coming that's going to support growers. Plus, and this is a big one, their U.S. manufacturing base could become a huge advantage with all the global tariff talk. So given all this incredible progress, it's really no surprise that management came out with some serious conviction. They officially reaffirmed their full-year guidance for both revenue and adjusted EBITDA. To the market, this was a clear, confident signal that they believe Q2 wasn't a fluke, and that this transformation is the real deal. So that's the story of the quarter. It's one where sharp execution and efficiency totally won the day. Now, let's put all these pieces together and lay out our investment thesis based on all this evidence. We're calling this one the Tariff-Proof turnaround trade. It's really a deep value play that recognizes these big structural changes that are happening inside the company, combined with a pretty unique macro catalyst that we think most people are overlooking.
We believe this story is far from over, and for 3 key reasons. First, these operational gains, they're structural, not just some temporary fix. Second, what we're calling the tariff turbocharge. Their U.S. manufacturing footprint is a powerful catalyst that we think is currently unpriced by the market. And third, the inventory inflection. Their internal efficiency is meeting a recovering external demand cycle. That is a very powerful combination. So, based on the very real, tangible progress of their transformation, that strengthening balance sheet, and the alignment of these cyclical tailwinds, our rating is outperform. We believe the market is just now beginning to re-rate this company for its new efficiency, not just for its old top-line growth story. The big question for investors now is, can this new operational discipline keep driving value even if the agriculture market recovery hits a few bumps? That's what we'll be watching. And as always, this analysis is for informational purposes only. It is not financial advice. Please be sure to do your own homework.